Most people think they are investing intelligently when they dollar cost average into the S&P 500 every month. They automate it, they feel disciplined, they feel patient, they feel like they have escaped the stupidity of stock picking and the vanity of trying to outsmart the market. And for a while, that feeling does a very useful thing. It keeps them from doing worse. But there is a dangerous difference between not doing worse and actually understanding the game you are in. That is the difference I want to talk about. Because the public was sold a version of investing that made sense in a different market structure, a different listing environment, and a different stage of American capitalism. The structure changed, most people did not. And if you keep applying yesterday's passive wisdom to a market that has quietly become more concentrated, more private, and more tilted toward insiders harvesting growth before public investors ever get a shot at it, then you may still survive financially, but survival is not the same thing as winning. That is where this story begins, not with a rejection of the index, with a refusal to worship it. Now let me say something immediately so nobody misunderstands me. Buying a low-cost S&P 500 index fund for decades is still better than the vast majority of foolish things people do with money. It is still superior to most expensive active managers over long periods. It is still a sane default for ordinary savers who need a simple, durable, low-friction way to participate in productive American business. All of that can be true, and something else can also be true. The index is not what most people think it is. That is the first harsh truth. People hear 500 companies and imagine broad diversification. They imagine a giant Democratic cross section of American enterprise. They imagine that by buying the market, they have escaped concentration risk. That picture is much prettier than the real one. The S&P 500 is now highly concentrated at the top. As of late April 2026, the top 10 holdings account for roughly 35.6% of the index by weight, and the top 7 or so dominant technology names still carry an extraordinary amount of influence. That means when people say they are just buying the market, what they are often really doing is buying a heavily weighted concentration in a small set of mega-cap winners with hundreds of smaller positions attached like polite witnesses. Faysight. Fay-turn 777,416 search 0 Fay-turn 777,416 search 4 Fay. Now, those are magnificent businesses. I am not here to insult Apple, Microsoft, Nvidia, Amazon, or the rest of the giant machines that have taken over so much of modern economic life. I am here to insist on accurate language. If 10 names can dominate more than a third of the index, then you are not buying a neutral abstraction called the market. You are making a large implicit bet that the existing dominant giants will continue justifying both their dominance and their valuation. That may work. It is not the same thing as old-fashioned diversification. And once you understand that, you begin to see the second harsh truth. The index has become more concentrated. At the same time, the universe of public companies has shrunk. This is one of the most underappreciated structural changes in modern investing. In the mid-1990s, the United States had roughly 8,000 listed companies. Today, it is closer to roughly 4,000, depending on how you count, which means the public market has been cut nearly in half from that peak, even as the economy itself has grown dramatically. This is not a tiny technical footnote. It is a change in where economic life actually becomes investable for ordinary people. Faysight Fay-turn 777,416 search 1 Fay-turn 777,416 search 5 Fay-turn 777,416 search 9 Fay. Now ask yourself what that means. If the public pond is smaller and the index is more concentrated within that smaller pond, then the investor telling himself, I own everything, is not really owning what he imagines. He owns a narrowed sample, a strong sample perhaps, but still a narrowed sample. And this brings us to the third harsh truth, the one that makes many ordinary index investors uncomfortable because it reveals something they were never meant to think about too hard. A lot of the most explosive value creation now happens before a company goes public, that is the shift. In older market eras, public investors got to ride more of the growth curve from relatively early stage to dominance. Today, companies can stay private longer because private capital is abundant and because the burden of being public is heavier than it used to be. The median age of a company going public in 2025 was 12 years, according to NASDAQ's own 2026 IPO commentary, older than in prior decades and part of a larger pattern of delayed listing. Other 2026 market commentary has argued the wait is even longer in some data sets and contexts. The exact number matters less than the direction companies are reaching the public market later. Faysite Fayturn 777,416, search 2, Fayturn 485,266, search 0, Fay. That means something very simple and very cruel for ordinary investors. By the time a great company appears in the public market, a great deal of the early, explosive, asymmetrical growth may already belong to private investors, venture funds, insiders, employees, or early institutions. You are not necessarily early. You are often arriving after the most violent part of the curve has already been monetized. That does not mean public markets are useless. It means public markets are increasingly where maturing success is priced, not where raw transformation is first discovered. This is why I say the stock market is not a scam. It is just the second half of the game. Now, before you run off and start worshiping private markets like some newly converted zealot, let me slow you down. Private is not magic. Private is simply where access has moved. And because access moved, the people who understand ownership at a deeper level have moved with it. That is the fourth harsh truth. The rich do not merely think in tickers. They think in ownership structures, private businesses, seller, financed acquisitions, equity rollovers, direct stakes, acquisition vehicles, operating cash flow. This is a different game from swiping open an app and buying more of the SP every month. And it is a game that feels inaccessible to ordinary people, mostly because they were never taught that it existed in a realistic way. The typical person thinks there are only two worlds: start a business from scratch or buy public securities. That is incomplete. There is a large middle ground of business acquisition, small private company ownership, local services, boring, recurring, revenue enterprises, and recession. Resistant cash generators that almost never get discussed in the mainstream investing conversation because they are not elegant enough for television and not liquid enough for app culture. But they are very real. And 2026 has made them more interesting, not less. Why? Because private equity is jammed up. That is the fifth harsh truth. During the era of cheap money, private equity bought aggressively. Deals were plentiful. Financing was cheap, and the standard plan was straightforward enough. Buy, improve, refinance, or sell, return capital, repeat. Then rates rose, exit conditions worsened, and the machine slowed. McKinsey now estimates that more than 16,000 companies globally have been held by buyout firms for more than 4 years, the highest share on record, and the typical hold period has stretched to more than 6.5 years. In other words, the inventory is aging and the pressure to exit is real. Faysite Fayturn 485,266, search 1 Fay now. Does that mean every ordinary investor can stroll into a conference room and start buying companies like a private equity professional? Of course not. I have no interest in telling fairy tales. The private market requires judgment, due diligence, patience, and a level of responsibility far above pressing a buy button. But when a system gets clogged with aging assets and motivated sellers, opportunities change, valuations change, deal structures change. Sellers become more willing to listen to unconventional buyers if those buyers can offer continuity, trust, or creative structure. That is the thing most people miss. The barrier is not always cash. Sometimes the barrier is imagination, education, and nerve. A founder nearing retirement may not want a faceless financial buyer who cuts costs and flips the company. He may prefer someone who will preserve the staff, protect customers, and carry the business forward with seriousness. In those cases, the transaction may involve seller financing, staged payments, minority rollovers, or structures the average person never studies because he was too busy being told the only respectable path was to buy index funds and wait. That is why I do not say dollar cost averaging is dead. That is theatrical nonsense. What I say is more uncomfortable. Dollar cost averaging into the SP 500 is no longer sufficient as a total worldview for someone who wants to understand how the rich actually build wealth. It is a tool, not a religion. It may remain the core of a sensible public market allocation, but if you believe it is the whole game, you are allowing a simplified retail narrative to replace a real ownership strategy. And that has consequences because the world of ownership is much bigger than the world of tickers. Public equities are one form of ownership, private businesses are another. And the latter still contains the kind of messy, unglamorous, unphotogenic cash flow that can change a family's life far more dramatically than another decade of praying that index concentration remains your friend. Now let me be honest about the danger on the other side. People hear all of this and decide the correct reaction is to abandon indexing, chase private market glamour, and pretend they have been called to become mini private equity barons. That is not what I am saying. For most people, the S&P 500 remains an intelligent vehicle for long-term wealth accumulation, especially inside tax-advantaged accounts. It is liquid, simple, diversified enough for the ordinary saver, and historically strong over long stretches. But historically strong is not the same sentence as the only strategy worth knowing. That is where the retail mind gets trapped. It confuses a good default with a complete worldview. The complete worldview is this: protect wealth in public markets. Build serious wealth through ownership wherever ownership still offers asymmetry, control, and mispriced opportunity. Sometimes that means public equities, sometimes that means a local service business, sometimes that means acquiring something boring with real cash flow, sometimes that means combining career skill with capital and trust to step into a company that never appears in your brokerage app. The investor who understands that sees the world differently. He does not drive past ordinary businesses thinking only of errands. He sees ownership, he sees succession problems, he sees retiring founders, he sees cash flow machines hidden inside unremarkable storefronts. He sees that what looks boring to the public often looks beautiful to capital. That is a different level of perception. And perception in investing is often the beginning of profit. So where does that leave the ordinary person in 2026? It leaves him with a decision. He can keep believing that passive indexing is the whole story and remain grateful for the second half of the game, or he can keep the index where it belongs as a useful, disciplined public market tool, while also learning how ownership works outside the ticker tape. That might mean studying small business acquisitions. It might mean talking to local owners. It might mean understanding seller financing and cash flow multiples instead of only price to earnings ratios. It might mean finally realizing that the road to wealth is not always paved with innovation stocks and Silicon Valley narratives. Sometimes it is paved with boring plumbing companies, HVAC firms, service businesses, industrial distributors, small niche operators, and all the other enterprises that actually keep ordinary life functioning while the public markets argue over whatever magnificent theme currently occupies the headlines. That is where I think this story really lands. The market moved, the best players adjusted, the average person kept buying the cleaned-up public version of growth after the richest part of it had already been harvested elsewhere. I do not say that to discourage you, I say it to wake you up, because once you understand that public markets are where you protect what you have and private ownership is often where you build what you actually want, you stop being merely a passive participant. You become a student of the full game, and that is where real wealth thinking begins.